We've had a fairly mixed last few days in the market where we notice the semiconductor space performing fairly well. We get Tesla down around 7% and the unloved company in the market, Google, down nearly 3%. Now, one thing we've noticed that is very interesting, at least over the last 12 months on average, is that institutions are actually selling a lot more shares than they are in fact buying. Maybe no surprises given that, as we've highlighted in the past, on valuation metrics, whether it's a forward P basis or even a price to earnings growth, many companies in the markets are trading at some very high prices. That also reflects their historical averages, and we can see now that institutions, for the large part, are selling more than they are buying. If we take a look, for example, at the Bank of America, whilst we know institutions over the last year bought around 22 billion worth of shares, they actually sold a lot more at 28 billion, and that's also reflected in the most recent quarter, where institutions for this company sold over $6 billion, whilst only buying around 3.1. Now, the reason we want to highlight that in today's episode is because we're going to uncover 8 dividend stocks that institutions are actually buying, and these are companies that are trading near their 52-week lows. We're going to pick some from the S&P with respectable dividends, and we're going to talk about our own valuation for each one as well. Kicking things off with Canadian National Railway Company. Now, this has a triple buy from every single analyst, Seeking Alpha, Wall Street and Quant. It does offer dividends of 2.3%, whilst also trading in the mid to lower end of the 52-week range. It is, however, down 15% in the last year. Year to date, it is now up around 5%. During Liberation Day, a lot of tariff talks, this was one company that we actually noticed below the $100 mark, and over the last 10 years, it has marginally underperformed the S&P, up around 79%. Now, if we look at the valuation of 18.2 on a forward P basis, that is below the 5-year average of 20.8. This in one way is an undervaluation signal, coupled with the fact the yield on a forward-looking basis of 2.4 sits above the 5-year of 1.9. That is again another undervaluation signal. And we can also highlight this third methodology here with the blue tunnel giving us the expected intrinsic value. As of today, it is sitting slightly below even the bottom end. This again another undervaluation signal, all three pointing that CNI could be a great opportunity here. As we said though, we're not looking at this in isolation, and we will run it through our own process too. We also notice a C- on the grading, where it does actually sit a little bit lower than the sector by around 3%, but as we just showed you, in comparison to their own 5-year, you're getting a fairly substantial discount. So definitely one that looks positive on a valuation perspective. And then when we flip into the growth grade, where they get a C-, year on year and forward looking is around the 3% mark, which is only slightly below the sector in the 3 to 4% region, but pretty much they're growing their top line the same they have done at least over the last 5 years, with earnings per share anticipated growth over the next 3 to 5 at 11%, pretty much in line with the sector and also a little bit above what they have done historically. Given we are talking about dividend stocks, we will uncover the growth the companies have had, starting off with CNI, 5% increase in just this year. Over the last 10 years, they've been increasing the dividends on average at 13% year on year, whilst also notifying you here that they are a dividend aristocrat with 25 years of continually increasing it. They also do expect growth over the next 4 quarters in terms of the earnings per share, whilst they have a 50% track record. 2 out of 4 beats, notably most recent quarter was a beat, and they're trading based on their 2026 earnings per share estimate on a forward P of 16.8. Now, unlike Bank of America that we touched upon at the beginning, this company is one that we're seeing more buying than selling by institutions. 81% ownership, 4.5 billion of sales over the last year, 5.5 billion during the same time frame, whilst also noting more buying than selling in the most recent quarter. In fact, we noticed double, 1.2 buy, 606 million worth of sales. Now, for each one of these 8, we are going to jump into our own intrinsic price, where we get to $118, the average of the 3 models that you do see on screen. Now, typically on this channel, we do run through the inputs and the outputs of each one of these models. Getting straight to it today, we also want to apply an MOS, where we execute on 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. So right now for CNI, a buy with a 10% MOS, Wall Street themselves, $120 over the next year, translating to 13%. So give us your thoughts. Yield around 2.5%, 10% MOS, 13% upside. Institutions are buying. Is stock number one a buy, hold, or sell? And we'll also flag here for those that want it at a 15%, a buy at $101, at 20% around 95, which is near the 52-week low. As we said, 10% MOS, 13% upside. Now we also want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to stock number 2, which is Merck & Co. Battered down nearly 40% over the last year. Year to date down 21%, losing 1/5 of their market cap in a matter of months. And over the last 10 years, they are up but only marginally at 35%, trading right there near their 52-week low, with a double buy from Seeking Alpha as well as Wall Street, and they do currently offer shareholders a yield of 4.2%. And whilst we won't get into it today, you can see the gradings: A- on valuation, A on growth, and an A+ on profitability. The forward P as of today at 8.6 is well below the 5-year of 13.4. That is one severe undervaluation signal. And you can also see the yield on offer, well above 4%, is significantly higher than the average at 3, another signal here of severe undervaluation. We also note here that this company currently trades outside of the blue tunnel. There is significant disparity. In fact, worth highlighting that from November last year, disparity has only got larger and larger. So again, another signal that this could be an excellent opportunity. Now the grading comes at an A-, as we highlighted earlier. In terms of the sector, it sits significantly above. You're actually getting a 50% discount, but you're also getting around a 50% discount, as we just showed you, to their own 5-year forward P. And their growth also comes at an A. Revenue year on year at around 4%. When we do compare that and the forward looking to the sector, it does sit a little bit higher, but so does their own 5-year. This is a company that has historically grown their top line at a quicker rate. Earnings per share expected 11%, that is above the sector, but we notice again their 5-year, this is a company that has grown a lot quicker. Now they did just increase those dividends in November last year at 5%, and over the last 10 years on average at 5.8% year on year. This is above inflation that we would typically target at the 4% level, and they've been increasing those dividends for the last 13 years whilst paying a dividend without a reduction for the last 54. They do also expect 3 of the next 4 quarters to be growth, 100% historical track record, and they're trading at a forward P around 8.1 in December 2026. Institutions currently holding 76% ownership, selling 17 billion over the last year, buying 29 billion, and we notice here buying around double in the most recent quarter, 4.3 sales, 8 billion worth of buys. Now intrinsic value gets to $111, again average of these 3, giving us quite an attractive margin of safety today, a lot more than what we just saw for CNI, pretty much bang on the 30% level. Wall Street themselves see this at 103 over the next year, upside of 32%. So let us know your thoughts. Merck & Co, 30% MOS, 32% upside. Do you see this as a very strong buy, or perhaps one to significantly avoid? We then move on to KDP, Keurig, Dr. Pepper with a double buy from Wall Street as well as Quant. The yield on offer sitting around the 2.8% level and trading near their 52-week low. We do see it down 6% over the last year. Year to date up, although marginally around 2%, and over the last 5 years this is up around 15 to 16%. We also again get a severe undervaluation signal. Forward P 16 below the 5-year of 20, and yield 2.8 well above their historicals at 2.21. So no surprises that we also get an undervaluation signal here, but actually interesting to note, for the majority of the last year this is a company that has been trading below its fair price. Now on the grading they do get a D+, but if you are looking solely at the forward P, the sector does for the large part pretty much sit in line, getting a 5% discount. Likewise, you're getting a discount but a bit larger against their own historicals at 19%. Growth looks okay at a C+, year on year and forward looking around the 4% level, above the sector which does in fact sit fairly low at the 1 to 2% mark. but interesting to see KDP has historically grown their revenue at a higher rate, around the mid to upper single digit mark, with EPS projected to grow around 7.2. That is slightly above the sector, but also slightly below their own 5-year. Now, their most recent increase was at 7%, and over the last 5 years, 8.2. Worth highlighting though, this is a company that has cut their dividend in the past, and they now sit at 4 consecutive years of increasing, while 6 years of paying a dividend without a reduction. And great to see pretty much green right across the board, outperforming against analyst targets, or at bare minimum sitting in line, whilst also projecting growth over the next 4 quarters, trading at a forward P of 15.1 in 2026. Quite high in terms of institutional ownership at 94%, 3.4 billion worth of selling, pretty much twice as much buying, and the same to be said in Q1, a lot more buying from institutions than we do see selling. And our intrinsic value of $38 does give a margin of safety at 10%, a buy at 34, at 15, not that far off, so KDP sitting somewhere between 10 to 15%. Wall Street see this bang on $40 over the next year, translating to 21% upside. Perhaps one to consider, or around the $32 mark, something we could see fairly soon. And at 20%, a buy at $30, at 25, around 28. As we say for now though, near the 15% mark with 21% upside. We then move on to Johnson & Johnson with a double buy from Seeking Alpha in Wall Street, a yield that sits above the 3% mark and trading towards the mid to lower end of the 52-week range, up 4% over the last year. Year to date, up 6%, and over the last 10 years, again, they're up around 56%, but this, like some others today, has marginally underperformed the S&P. They also trade at a fairly low forward P of 14.5 against the average of 16.2, whilst also offering yield 3.4 above their own historicals that sits at 2.76. But this is a dividend king. Their most recent increase, 4.8% just a few months ago. Over the last 10 years, 5.9% on average. And as we said, dividend king, that means 50 plus years of consecutively increasing the dividend. But on top of that, they've been paying one for the last 109 years without a reduction. Their valuation does get a D+, but we can actually see it trading at a 16% discount to the overall sector. Will come down to which actual valuation metric you like to see. The only one where they do score fairly poorly is price to book, but on the others we can see it trading at a fair discount to the sector. Their growth, nothing too great at a D-, 4% year on year, pretty much the same expected moving forwards. Sector does sit a little bit higher, and so does their own 5-year average. EPS estimated to be 8.3%, marginally below the sector, but actually quite higher than the 5-year, which sits at 5.1%. We can also show you when looking at this valuation model too, it is now sitting just below the bottom end of the blue tunnel, so we do get an undervaluation signal. But also interesting to see, this isn't a company that typically sits at an overvalued level. At least over the last year, it has been sitting right there towards the bottom. And in terms of earnings, they expect 2 of the next 4 to be growth, with a 100% track record, a fairly consistent company, trading December 2026 numbers, forward P 13.8. Institutions currently holding 70% ownership, 18 billion worth of selling, 32 billion worth of buying, and again we see in the most recent quarter, institutions buying nearly twice as much as they have been selling, another dividend stock that they clearly do like. Now, intrinsic value of $175 gives a margin of safety at 10%, up to 157. At 15, 149, not quite there yet. So for the dividend king J&J, we see 10 to 15% MOS, with Wall Street themselves $172 price target, 12% upside. Is this dividend king for you a buy, hold, or sell? We then move on to AbbVie with a double buy from Seeking Alpha and Wall Street, a yield around the 3.5% mark, whilst also trading in the mid to lower end of the 52-week range, up 16% over the last year, year to date up 5%, and over the last 10 years, this one outperforming the S&P, up 179%. Remember, this would be higher if you were to have reinvested those dividends over the period. This one interestingly shows an overvaluation signal given the forward P sits above the average, as well as the yield of 3.5 below the historical of 4, which is also reflected when we take a look at this model. Good to see the blue tunnel increasing over time. As we always say, this is something you really want to note, but also one that we can see trading in an overvaluation space solely on this model on a 12-month basis. And their grading, even though it does come at a D, we do do highlight it's trading 12% lower than the sector, but as we highlighted moments ago, trading 26% higher than their own 5-year. Growth at a D-, but year on year and forward looking in the 5 to 6% region, the sector only very slightly higher, but one thing that doesn't look great is that they were growing it at a slightly faster rate over the last 5 years. EPS though looking very strong at 13%, that is above the sector at 10 and their own 5-year of 5, with 3 of the next 4 quarters expected to be growth, 75% track record, trading December 2026 on the earnings per share estimate at a forward P 13.4. Last increase was at 5.8%, but double digit over the last 10 years at 13.6%. And this one, very similar to Johnson & Johnson, is a dividend king. 53 years of consecutive increases, 101 years of paying a dividend without a reduction. Institutional ownership, 70%. We see around 19 billion worth of selling, 29 billion worth of buying, and nearly twice as much buying in the most recent quarter. Institutions do like AbbVie. Now, intrinsic value, $214, will give you an MOS of 10% up to 193. At 15, not quite there yet, very similar to Johnson & Johnson, around 10 to 15%, with Wall Street themselves seeing this at 214 into 2026, upside of 14%. So let us know, do you like these dividend kings, or perhaps you don't like the growth as well as the upside, you want to see a little bit more. We then move on to FedEx Corporation, double buy from Seeking Alpha and Wall Street, a yield around 2.5%, whilst also trading near their 52-week low, down double digit 11% over the last year, down 22 just in 2025, and over the last 10 years, bit of a roller coaster for those who are shareholders in the longer term, up only 19% in the last 10. We do, however, get the double undervaluation signal, forward P 11, 5-year at 13, yield 2.5, 5-year at 1.92, and we can see here it is sitting right below even the bottom end, all 3 points, FedEx looking undervalued. Valuation grading looking good at a B2, you are getting a massive 37% discount to the overall sector, but that's pretty consistent no matter what valuation metric you look at. FedEx as a whole trading at quite a large discount. Again, the same to be said when you compare it to their own 5-year average. Growth leaves a lot to be desired at a D, year on year and forward looking pretty much flat, when we do notice both the sector and their own 5-year sitting in the mid-single digit. In terms of EPS, they're projecting around 9.2%, which is below both sector at 11 and their own 5-year at 13. Now, they did increase their dividend a year ago at 9.5%. Will be interesting to see what shareholders get over the next few days. And over the last 10 years, they've grown this at 23% year on year. We can see though only 4 years of consecutive increases, with 22 years paying without a reduction. They do, however, anticipate growth over the next 4 quarters, although we do see a 50% track record, and most recent quarter was a miss by 11 cents, trading on May 26 numbers at a forward P of 10.8. Now, institutions, 84% ownership, 5 billion worth of selling, 6 billion worth of buying, but we see here 50% more buying than selling, 1.5 versus 1, and our intrinsic value at $286 will give again a fairly attractive margin of safety. You're getting 20% up to 229, 25 around 215. So FedEx Corporation near a 25% MOS. Wall Street see quite a lot of upside, 28%. They project this $280 into 2026. Do you agree? Is this one you hold, or perhaps one you've been a longer term shareholder of and don't really like the future growth prospects? We then come back around to the railroad industry with Union Pacific with a double buy from Seeking Alpha and Wall Street, a yield near the 2.5% point, trading towards the lower end of the 52-week range, and it's down 3% over the last year. Year to date, also down. Over the last 10 years though, a fairly similar performance to the S&P, up 120%. Its forward P of 18.8 is below the 5-year average of 20.6. You're also getting a yield of 2.43 above the 5-year rolling. And whilst we do in fact see here a reasonable valuation signal, it is sitting right at the bottom, so you could also argue again another undervaluation point for this railroad company. The grading itself is a C-, but we can pretty much see this is valued at the same level as the sector overall, but as a slight discount to their historicals. Growth at a D, not great, but realistically the industry as a whole isn't a fast growing one. We notice here forward looking 2%, with the sector sitting above at 4.6, but so does their own 5-year. In terms of EPS, projected at 9.3, again very similar to their revenue, slightly under both sector and their own 5-year around the 10 to 11% region. In terms of growth, last July 3.1, not that great when you consider over the last 10 years it has been at the double-digit rate of 11%, but they've been increasing it for over the last 18 years consecutively, whilst also paying 26 without a reduction. Over the next 4 quarters, they anticipate each one to be growth, 50% track record, although most recent one was a marginal miss, trading on 26 numbers, forward P 17.2, and institutions hold 80% ownership. They've sold around 9 billion over the last year. They've bought nearly twice as much at 15 billion. Again, the same to be seen in Q1, nearly twice as much buying from institutions than they have in fact been selling. And our intrinsic value at $254 will give you a margin of safety of 10% up to 228. At 15, not quite there yet, not far off at the $216 mark, near 15% MOS, 16% upside, $255 price target. Maybe you like the railroad companies, maybe you don't, or you have a preference. UNP, CNI, what are your thoughts below? We then move on to PepsiCo with a triple hold from every single analyst. It is paying a yield above the 4% level, very rare for this company historically, trading right there near their 52-week lows, down 24% over the last year, year to date down 14%, and over the last 10 years, not the greatest, up only 41, underperforming the S&P 500. Forward P showing severe undervaluation levels, 16.4, the lowest on offer to shareholders over the last 5 years, when the average has been 23.8, and we can see yield of 4.32 above the historicals of 2.9, and probably no surprises, we get that confirmation of severe undervaluation, and you can see very consistently undervalued in just the last year. They're also trading pretty much the same as the sector around the 17 mark. However, their 5-year a lot higher, you're getting a 30% discount. Very consistent though, no matter what valuation metric you look at today, Pepsi against their own 5-year is sitting much lower. Growth not the greatest, pretty much flat both year on year and forward looking, although the sector as a whole, again, not really an industry where we're seeing a lot of growth, at least for the time being. Historically though, they've managed to maintain growth at the mid-single digit point. EPS leaving a lot to be desired at 4%, when the sector and also their own 5-year sits higher around the 6 to 7% level. 3 of the next 4 quarters anticipated to be growth, 75% track record, although they did in fact miss their most recent one very marginally at 1 cent. Trading on December 26 numbers at a forward P of 15.6, and they did just increase the dividend this year at 5%, although historically it's sat higher at 7.7, and we notice another dividend king, 52 years of consecutively increasing the dividend. They've also been paying 60 years without a reduction. Now, institutional ownership sitting at 73%. They sold 10 billion over the last year. They've bought twice as much at 20 billion, whilst also buying nearly twice as much in the most recent quarter. Another one like the previous 7 that institutions are very bullish on. And our own intrinsic value at $161 does give you a margin of safety of 10% up to 145. At 15, at 137, at 20, not quite there yet, but not far off. We did see it at that level just yesterday. So near 20% margin of safety. Institutions are buying, yield above 4%, price forecast 162, meaning Wall Street see this at 23% gain in the next 12 months. Give us your thoughts about Pepsi as well as the previous 7 that we have covered, whether any of these at a bare minimum are now on your watch list. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in a Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.